Hello, financial freedom fighters. John Thorman here, and I'm happy to be back talking to you about our series on the ideal attributes of the perfect retirement plan and how our tax-free retirement plan options provide all four of those benefits. Just as a real quick reminder, when we talk to people about describing the perfect retirement plan, the common answers we get are that what people are looking for ideally in the perfect retirement plan would be, number one, that the growth on the money is tax-free, not just tax-deferred, but tax-free. Number two, that they would be able to earn good rates of return on their money. Number three, that they don't want any risk of loss, like what we typically experience in the stock markets every few years. You'll recall not too long ago, well, maybe you won't recall, but you should remember 2008 was a disaster, and people lost over half of their retirement accounts overnight. And number four attribute of the ideal retirement plan is people want liquidity, meaning they want to be able to access their money when they need it, and they don't want the government interfering and telling them when they can or can't have it, or charge them penalties for accessing that money. And so let's take a look at it. The most common retirement plans in the country are 40 years old now, right? It's the 401k plan or the IRA, traditional IRA, or some version of a tax-deferred retirement qualified plan. And all of those plans have got rules and regulations about when or if you can access your money. And that's not liquid, right? That's not a good situation. And so I find a lot of small business owners, a lot of entrepreneurs will shy away from saving for their retirement in a qualified or tax-deferred retirement plan, specifically because they don't want to have that restriction. They don't want to have that limitation placed on when or if they can access their money. So 401ks, like we're talking about, those all have limits, right? You can't get to the money in most cases before age 59 and a half. There are some exceptions. You could possibly access a little bit limited amount of money for a down payment to purchase a home, but it's a loan that has to be repaid. And if you leave jobs, all of a sudden now that loan has to be repaid in a short order. Otherwise, it's considered a distribution, and now you've got to pay a penalty for early distribution in addition to the taxes on it. So not a good situation if you're concerned about liquidity. Enter the tax-free retirement plan options, the alternatives that we've got available. With our programs, the monies that are building up inside the contract are available to the contract owner whenever they want. And those balances are made available as loans, and they don't have to be repaid. So, and what's interesting is all of the money stays on deposit earning interest. And it could earn 6% or 7% or 8% or more, but you've taken out some money and it's a loan, but you're only paying the loan, the interest charges on that loan are only 4, 5, 6%. So you've got a positive margin, right? So you're earning money on the spread. So let's say you got $100,000 in your account and you borrow $25,000. Well, you still earn interest on the account of the whole $100,000, and the little bit of loan payment or loan interest you have to pay on the $25,000 is covered because you're making money on it. So there's no additional out-of-pocket expenses. There's no repaying of that loan. If you don't want to, you can just borrow the money and take care of what you need to take care of. Of course, if you want to repay the loan, that would be great. And because that's really the idea to begin with, is we're looking to accumulate a large sum of money for a tax-free future, right? So our plans give you way more flexibility, way more access to your money when you want it or need it without these IRS penalties for early distribution and without loan payments and interest charges that you're going to have to pay back. So I am really excited to show you some examples of what this could look like for you personally. But in my next video, I'm going to do an example. I'll probably start out and show you what it would look like for a 35-year-old male person and run the illustration and give you some examples of what you could expect. But to find out what it will look like for you personally, reach out to me. Hit the link below and book an appointment so we can look at a one-on-one situation. But the benefits are enormous the sooner you get started. You want to start early, put as much money away as you comfortably can for your budget, and give it time to compound. Okay? Don't wait. You get into your mid-50s and it's so much more expensive. You have to have a significant cash flow. And there are people that do, obviously, and we work with them. But I'm telling you, young people, get started early. Start early as possible, and start putting a few $100s a month away. The more, the merrier. But I'm going to show you specific examples on the next video. So if you like this, please be sure to subscribe to the channel. Hit that bell so you're notified of the next video. Drop a comment, leave a note, but like this and share it with others that you think would be interested in learning about it as well. So that's all for today. Remember, liquidity, you want access to your money. Don't put all of your money away where it's going to be tied up and you can't access it without incurring penalties and taxes, okay? We gotta change that up and keep your money liquid and available and accessible. So that's all for now, and I look forward to seeing you on the next video. Bye-bye.